What's my edge in oil trading? Conviction. With Sparta Curves, I get real-time, trusted prices from 30-plus top brokers. Futures, swaps, physical, and freight, all in one place. Switching from Bloomberg or Refinitiv only took 15 minutes, zero disruption. Now, our whole team runs on one flow. Sparta Curves, 45 days, free, no risk, no friction, just conviction. Start your free 45-day trial by visiting spartacommodities.com/curves.
Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.
So welcome back to the Sparta Market Outlook, your weekly snapshot of what's driving the global oil markets. I'm your host, Rachel Williams, and this week we have Jorge, Phil, Neil, and Michael on the call. Hello, everyone.
Good afternoon.
Hey, Rachel.
So yet another week with a whole bunch of headlines. First off, we'll talk about what's driving flat price higher. That means US trade deals that have avoided worst case scenarios, as well as the seemingly increasing threat of US-Russia secondary sanctions, with Trump reducing his 50-day deadline for Russia down to 10 days if there's no progress on ending the war. So that's a nebulous statement if we've ever heard of one. Then we'll dive into the physical world of oil as usual, including some chat on freight markets, as we have Michael joining us, light ends and crude. So let's get started here. Neil, why don't you start us off on some interesting headlines this week?
Yeah, I can go. So guys, obviously feel free to jump in where you like, but the one thing to pick up on, I think, is just the behavior of flat price. So now we're almost at $73 for Brent. If you take out the period where there was the Iran bombings going on, that's, I'd say, the highest price since basically Q1 of this year. So it's a bit of a milestone on that. And the thing is that there's a few levels of support. One is the Russia story. The other one is, I think it's things like trade deals. So the US-EU trade deal was a bigger headline this week. And you see that and you look at equities are at record highs and it all just seems a bit euphoric at the moment, I would say. But I guess the reason I'm picking up on this is that all this has really done is kind of avoid the worst case scenario, right? So the global tariff burden is still much, much higher. As far as I can tell, most people who are looking into or commenting on basically the macro outlook for the second half of the year are still pretty convinced that there will be a strong weakening in sort of economic growth as a result of the tariffs that are already in place. And of course, it's not our specialty, macro, but it's just to point out that we have a basically euphoric market right now and the outlook is not so good. And in terms of the data that's coming in to try and look at the effect of tariffs, it's not really the right time to see the full effect yet, right? Because it takes some months for the impact on inflation, particularly if there's been front running and stocking up. And it just feels a bit euphoric. Does anybody disagree, want to add?
Equity markets definitely feel euphoric. And you talked about the tariff impact, and I know that Apple reports earnings later this week, and I think that'll be a good read on tariffs. Not anything to do with oil directly, but just in regards to the tariff impact on a US-based company. I think it could be a canary in the coal mine.
Yeah, I suppose there's also then the big beautiful tax cuts bill, which will maybe help a little bit on some of those readings as they come through. So maybe equity, some of those tech companies or other companies that are going to be driving equity markets are going to have a little bit of a, I don't know, if at least in the US, a little bit of a shielding, and it's maybe readings from outside of the US that are going to see more of the pain early on.
Yeah, we tend to get kind of, well, everyone knows, right? The data set kind of in commodities and certainly oil is always lagged anyway. So yeah, looking forward to seeing Apple stocks. That was a really good tip. I didn't realize that was coming out this week. So look, the other thing supporting flat price, you've mentioned as well, looming deadline on Russia from Trump. Have you got any views on that, Neil?
Yeah, I've got some views. They're all sort of low conviction. I guess I was wondering what to say about this. I guess it's more of a, for want of a better phrase, like a spidey senses thing, right? It just feels like something might be afoot, and we've been discussing this earlier this week. It feels like from a sort of personal political point of view, the timing might be interesting, right? Because Trump, how do we say this? Trump has lost the narrative on certain things, like the Epstein files, and his approval ratings particularly low. And so far this year, he's been made to kind of look foolish on the Russia situation by his own admission, really. Yeah. And the sort of statements from him and Besant this week have been fairly consistent. And so from that perspective, it seems like a good time. From the market perspective, it's a good time. We've just talked about basically equities, which Trump is sensitive to. And on the other hand, you've got OPEC who are unwinding. So that timing is relatively good. And the one thing I was going to talk about is, okay, US doesn't want to rock the boat with these trade deals. But if you look at the headlines this week with the US-Indian story, it's not going well. So maybe I would have to sort of backtrack on that thought. And as I say, it's kind of a low conviction thing, but it just feels like there might be a higher chance that these sanctions actually go through. And I think that's also something that flat price is starting to reflect this week as well.
Fair enough. Spidey senses is obviously a technical term, right?
Yeah. There's another one. Yeah, I mean, I don't want to sound stupid, but it obviously could be a completely different story by this time next week or in 10 days' time, let's say. But it's just maybe a feeling, and it would be a substantial thing, right? Because if we just take India takes 2 million barrels a day of Urals now, and India can stop buying, but it's not very, they can do that fairly quickly, but it's not very clear that 2 million barrels a day of Urals can rapidly clear to the rest of the market. So that would be very, very bullish flat price initially, very, very bullish to Dubai. We were just discussing what the Indian slate might be. It might be kind of half Dubai based and WAF, and they might end up taking lots more WTI. So it'd be really, really substantial. The other thing that's been in the news is Nayara. So that was part of the European sanctions, I suppose. Michael, you can jump in here, but there was the headline that Nayara's actually running lower because of these sanctions, if you like. And I think I saw the statistic that they're running at 80%, which is still quite high. So it's not like a complete disaster. But one of the things is it's basically logistical. So the ship's legitimate fleet has turned away from the refinery. And do you want to pick that one up? Is that something that can't be dealt with?
So in regards to the legitimate international fleet and say the dark fleet, there's definitely enough capacity in the dark fleet to continue to do that business. It's just if Nayara wants to stay in that sort of narrow path where you use the dark fleet, because that massively limits all of your options.
Yeah.
And not just into the ports that you can go into, but if Trump continues to ramp up sanctions and if they're adopted by perhaps other regions like the EU, then your limits drop even quicker. Your options, excuse me. So they can use the dark fleet and there is capacity, but you only have a few options.
Yeah, optionality is not great for that one. Okay, so we've been talking about this over the last couple of weeks. We've got a OPEC meeting coming up this weekend, correct?
Sunday. It's widely expected that they'll hike, and that'll be another 500, basically, a bit more than 500. That will complete the 2.2 million barrels a day voluntary tranche from the group. We've talked loads about what this means for actual exports. Yeah, I think that's fairly baked in. The one thing I'm thinking now is that probably to protect flat price, they might talk about a pause.
Okay.
And that may be well received by the market, just to sort of observe how the market responds. And the other thing to talk about that, just to reiterate, the official hikes does not mean that they export that marginal number. And it seems to me a bit of a coin flip still in the market. We're still waiting for evidence of how much they export post-summer, and we're just not there yet. I've been talking about it for weeks. I've probably been talking about it a bit early, but it's still, for me, a kind of a coin flip and not very easy to trade.
Yeah, the pause is going to be quite interesting as well, because we do, by the time kind of that, if there's additional volume that comes into the market, it coincides with actually utilization rates coming off because we go into global maintenance. So, okay, one to watch then. I'm sure we'll have a snippet out kind of first thing Monday morning on that and on the impact of it. Okay, right. Last one for today, kind of just on the headline side, Chinese product exports are rising. What are the implications on this?
Yeah, I'll go again and then hand off to the other guys. Yeah, so that was another headline that the Chinese product exports are basically rising. The most interesting one there, I think, is distillate. So probably July distillate exports have doubled from a kind of a low level, so 100 to 200 kbd. It's not catastrophic, but it's something that we've been talking about, right? If Chinese runs are high, if their internal demand is weakening, and margins are high abroad, then it makes sense that they actually start to rebalance this market. And there's early signs that they are doing that. And that's also interesting from the crude perspective, because it means they move from max crude build to crude build plus product exports for the same level of import. So it's net bearish for the oil market. It's early days, but if this kind of thing continues, then ultimately it's a margin weakening mechanism going forward.
Yeah, fair enough. Makes sense on that one. We'll keep an eye on that over the next couple of weeks and maybe get June back on as well if that progresses further. That's actually a great segue to hand over to Phil on gasoline, because I think you wanted to talk about China too, Phil, right?
So starting in the east today for gasoline, C92 has seen the bigger share of the downside over the last couple of weeks. And when we look into the details, it does seem to be largely based on those increased Chinese exports. So the C92 blend margin that we run is essentially open. And when we look into the blender, it's because it's running Chinese 92 RON oxy barrels, it's running MTBE, which is coming from China. So it's really kind of pressuring the pricing center. And then, so that's on the supply side. From an ARB perspective, so on the flip side, we would say that kind of east-west and relative freights at the moment are kind of at a level which should actually be pulling Asian barrels still trans-Pacific, and not allowing European barrels kind of any further than West Africa to come east. So fundamentally, we should be relatively supported, but C92 has not been able to really kind of respond to that because of that Chinese pressure on the exports. I have seen one report suggest that maybe the August gasoline export plans are a little bit lower. If that turns out to be true, then from a demand perspective, at least, we haven't seen anything other than the odd kind of small cancelled tender here and there, which would point to any kind of demand weakness. So if we can see that supply pressure alleviate, then maybe the East has a little bit of room back to the upside.
Yeah, fair enough. So some balancing factors in Asia despite the Chinese pressure then. So how is it looking a little bit closer to home, given that we're in Europe?
Yeah, exactly. So for Europe, I typically look at three main signals, which is the ARB, the E10 or E5 blend margins, and those swing ARBs into the Atlantic Basin, all of which are particularly bearish at the moment for EBOB spreads. So at least from what we're seeing in the platform, we have a very closed ARB. I think we talked about that before, but it's throughout the rest of the year now, but at least for August and September, very closed, even for refiners. The swing ARBs into LATAM all point strongly towards the US Gulf Coast over ARA, and the E10 blend margins are now very workable. Last night, there was another tick lower in both Reformat and C5 component prices in ARA, which has really helped to make that E10 blend margin open, despite, I think, some narrower gas nap on the paper side. So I think that there's two things that I would like to just throw out there quickly on the back of that. The first one is Michael, I guess, kind of really open ARBs out of the Gulf Coast and really closed ARBs out of Europe. Is it fair to, in my kind of very basic understanding, to say that's bearish TC2 but bullish TC14?
Exactly. So TC14 has rallied some over the last couple of weeks, and that's in part because TC2 and demand out of ARA has been so bearish up until very, very recently. So ship owners generally didn't want to fix a ship to go TA because it meant that their vessel ended up in Europe where there wasn't really much demand. So TC14 was moving up 5 world scale point chunks at a time just because of owners' lack of wanting to do the route. Not so much for any other fundamental type reason. So TC14 started to move up, but interestingly, what we saw is that those LATAM arbs loading out of the US Gulf Coast, so your diesel and your gasoline into Brazil, Argentina, Ecuador, Guatemala, those arbs widened even as your freight rates moved higher. So generally what that means is freight has some pricing power and those countries are pulling barrels rather than the US Gulf Coast pushing barrels. So the demand is there, and that has been what has kept TC14 rates sustained. It's not so much your TA arb, which that diesel arb is slammed shut. It's your barrels being pulled into LATAM. And on the back of that, you're exactly right, Phil. Like TC2, when I look at the arb profile of everything loading out of ARA, freight rates need to move lower. Your gasoline arb is shut. Your naphtha arbs into New York aren't looking good either. So I would expect as we get a little bit deeper into the load windows of August that your TC2 freight rates come off.
Okay, interesting. Looking forward to picking up kind of with you, Jorge, just on the naphtha side as well. But look, before we kind of move off gasoline, I don't want to harp on about the RBOB market, but it hasn't quite been doing what we've expected over the last couple of weeks. So Phil, your commentary yesterday suggested that you are sticking to your guns, but maybe your timing was off.
Yeah, it's kind of you to say
not wanting to call you out on this one.
Kind of you to say not doing what we expected rather than what you expected in the last couple of weeks. So, but yes, no, PAD 1 specifically, or RBOB in general, it's true. Inventories are still relatively high, kind of versus the last couple of years. And it looks from what we've seen kind of reported that arrival, so kind of gasoline on water, is still expected to be relatively strong over the next couple of weeks. So that's the open arb from earlier in the month, plus some barrels coming in even from the east of Suez potentially. Bayway returned maybe faster than was expected, and Colonial Pipeline is rammed full apparently. So it seems to be kind of justified now that the very prompt TAR is shut. The question for me though is now on a timing basis, because everything is so bearish as in terms of the EBOB side of that picture, and the arbs are so shut into PAD 1, and there's always this kind of potential risk as we move through Q3 that you get some kind of one-off events or anyway a kind of seasonal bit of a draw on the US gasoline stocks, that just in terms of balance of risk for the rest of the quarter, I would still rather be longer RBOB and shorter EBOB. So i.e. long TA arb. It seems I went a bit early in July and kind of didn't put enough weighting on the fact that the inventories were still quite high. But at some stage that kind of has to happen, because the forward pricing, at least for the rest of the quarter, is just probably doesn't feel sustainable at this rate.
Okay, so doubling down then, holding firm, very much looking forward to kind of seeing how this plays out in the next 2 weeks.
Yeah, I'd have been stopped out in reality. That's why I'm not a trader apparently.
That's absolutely fine. Okay, let's carry on with the cleans. So Jorge, we've seen a big drop in the gas nap during the last 2 weeks. Let's move to the other leg of the equation. So has the naphtha market justified that movement?
Yes, as Phil has commented, we have seen a very big drop on gas nap, especially in August, $25 per metric ton in the last 20 days. And we've seen the indicators in ARA for gasoline look bearish. And on the naphtha side, we've seen the opposite during the second half of July. The main movement have been seen in time spreads. Crush have also rallied, but August-September time spread is at yearly highs. So we've seen a rebound of $5 per metric ton. It was close to contango in the beginning of the month, and right now we've seen this time spread skyrocketing and also strengthening all the back of the curve. So looking backwards to this before this rally, we saw an alert on the arbitrage that we have been talking about in the last couple of reports. So the arb from Med has been flowing to the east for the last 2 months until middle of July, and then we start seeing very big pull signal from Northwest Europe. So this was the main indicators that gave us a bullish idea on time spreads and cracks in Northwest Europe. And then there were another combined elements. Europe was the best option into Brazil, cheaper than US Gulf Coast, and also combined with divergence between the physical and the paper in Europe. So the paper was very close to contango, and the physical started to increase from negative to positive values. So with all of this, I think the main highlight would be the arbitrage is right now working. We are seeing strong margins in our tool from Med to Northwest Europe, and that has supported the European market.
Fair enough. So have we seen this particularly tight market also in the East, or has the market followed Sing 92?
It's a little bit like a mixed perspective. It has been more or less flat, a little bit stronger week on week, but it haven't followed Northwest Europe rally. Yeah. So, and if we look at East West, we have seen a very strength on the pure East West, and a very big downtrend on East West box. So right now it's trading negative for the August contract. So the Europe has been the main market in the NAFTA global markets, and it has outperformed Singapore and the Asian ones. Right now, with this movement, higher cash diffs in Europe and lower East West, the ARB is completely closed from Europe into Asia, also from US. So and also the weak Singapore 92 complex it's also playing a role in there. So what we have seen during these weeks is negative cash diffs in the East. It's the first time that we've seen it in 2 months, and the ARB is completely closed. So it has not been as strong as Europe, and the perspective look weaker.
Fair enough. So are we going to expect this uptrend to keep going in Europe, or are there any bearish risks in the short term that you're considering at the minute?
Yeah, I think the picture has changed. We have been talking about opportunities for European sellers, and this has changed to threats right now. So I've already talked about the up to the east. It's already closed for deliveries in end of August, in September, and the arbitrage is opening up to work into Northwest Europe. So we have $5 per metric ton margin. We don't need more, and there are several bearish risks added to this trend. So we have the ARB open from US Gulf Coast into Europe, not just for heavy barrels, but also for light sweet ones, deliveries in the second half of August. So we have changed one potential outlet for one supply that could come from US Gulf Coast. And the last bearish signal I've seen is the pronaps. We have seen them drop well below the historical average in Europe and in Asia. So that means more feedstock could be replaced in the steam cracker pool.
Okay. Michael, is there anything else that we're missing kind of from the clean freight perspective that you wanted to add before I go back to Neil and challenge him on some crude stuff?
Yeah, for sure. And a couple other things I'd like to loop back in on too. So, what Jorge was talking about on Naphtha, just something I've seen in the past, probably the last 3 or 4 months, when I look at the different rankings of how regions are delivering Naphtha into the Far East, it's rare to see the US Gulf Coast pricing Naphtha as the best source, at least for heavy Naphtha, into the Far East. But I've seen that happen twice in the last 4 months or so for brief periods of time, say a week. And that's Houston beating out the Med or the AG, delivering into the Far East. And generally, what I've seen happen in regards to TC5, which is kind of your mainstay of Naphtha from the AG into the Far East, is that roughly 2 weeks or so after Houston is the number one pricing center of heavy Naphtha, we start to see demand really drop off for your AG Naphtha barrels. And your AG Naphtha has already been shut for maybe almost a month now. But I think that your demand for LRs out of the AG is really going to tick lower as we get deeper into August. So we mentioned canary in the coal mine about Apple earlier. I really think that when the AG is pricing Naphtha this poorly into the Far East, you start to see that turn into a lack of demand for LRs out of the AG.
Okay, so
I think it makes sense also with the European perspective. So if Europe is not gonna send right now LRs into the east, it also will contribute to this logic.
Yeah, it makes sense. So it's just regional demand then for your LRs. I think you got to get bearish as we head into August there. And then just one interesting thing to note, because Phil was talking about the CPP China exports a little bit earlier, and just something that I've seen, you would expect to see an uptick in the demand for tonnage out of that sort of Singapore to Northeast Asia corridor. But what I've seen over the last month is tonnage counts have generally been ticking up. So perhaps owners thought that there might be more demand for tonnage and move their vessels over there. But as I've spoken with Neil on this in the past, I've not really seen that happen too much. Like in regards to OPEC, I haven't really seen owners positioning their fleet to take more of those barrels before those barrels are actually flowing. But just when I look at the tonnage counts now for the East, for MRs, they're all above their trailing averages at the moment.
Okay, so people positioning kind of a little bit stronger than kind of previous then.
It seems like they're positioning, because I would expect the counts to be drifting lower basis higher exports, but I've not seen that impact on vessel counts yet.
Okay,
which is a bearish signal for Eastern freight.
Yeah, fair enough. One to watch. Thank you guys for that. That kind of sets us up really nicely on the top part of the crude tower, shall we say. So Neil, moving on to crude. One of the biggest moves on crude last week or two has been the EFS. We've talked about it last week. You've been saying that it's been a bit of a puzzle this week. So what's going on there, and where do you see the EFS needing to go next? Bearing in mind, I know that this isn't a trade that you would love to put on.
Yeah, it was a mixed bag, I guess, on various crude calls this week. If you recall, last week we had a small discussion with June as to where things would need to go, and June was saying Dubai needs to weaken, which made perfect sense, and I was saying maybe it doesn't weaken as much, and I think I was right, but completely for the wrong reasons, right? So, the EFS has been really narrow, and it's come from both the Brent side and the Dubai side. So Dubai spreads have actually strengthened, and except for today, Brent spreads were quite a bit weaker. And it's sort of explainable, but let's say hard to predict. So it definitely seemed like there were some, let's say, benchmark dynamics going on. So there's definitely been a bit of a shortage of Murban for various reasons. One being that ADNOC maybe is pulling more Murban back into Ruwais. Yeah. And another one being some surprise Indian buying. Let's say that's an element we didn't pick up on too much last week, is kind of preemptive Indian buying on the spot market, with threat of Russian sanctions or tariffs. And we have seen, some of these things will be reversible unless we get a new situation. So the Indian buying, we've seen in previous iterations of these tariffs that Indian did buy more on the spot market, and then they kind of reverted back to Russian crude. So unless we do get these mega tariffs, then Murban should ease, so to speak. And it kind of makes sense also from the fundamental picture, right? We've talked about this for 2 weeks already. All the ARBs are now open into the east as a result of EFS, as a result of the spot diffs. TI is extremely cheap into the east. 40s is open, lots of medium crude is open. And also just looking at the supply-demand direction, right? There's turnarounds coming up in Asia. There will be some higher OPEC exports within the next few weeks. We'll get more direction on that. So I think it still makes sense that the EFS should widen out again. And I'd say it is working out this morning. I just don't think it's really attributable to what we've just discussed. I think it's rather a flat price effect, because the flat price is just rocketing up for the last couple of days.
Fair enough. So Dubai seems a bit fundamentally overbought then in that case. So, right. So that's one major spread. What about TI Brent? Because you've also expressed some puzzlement about the levels right now. What are your thoughts?
So I think we had a decent call. So in the early half of July, we were basically saying TI spreads would need to narrow, and it worked out for the September TI Brent, but then we kind of reiterated that, or I kind of reiterated that last week for October, and it's not worked out at all. And it's puzzling a little bit in the sense that TI is really extremely cheap all over the place, including in Northwest Europe, including in Asia, as I've just been talking about. And so I guess the puzzlement there is that the same reasons we've discussed before, US stocks are tight. Even a sort of very optimistic forward view of US balances would still be talking about draws for the next couple of weeks. So I'm kind of surprised that TI can remain this cheap. And we've talked about the fact that the MEH diff can't really be allowed to rise too much because it will draw on Cushing. And yeah, at the moment, TI Brent's widening out against what I thought it would do. And yes, it's more about just thinking, okay, what's behind this? And the one thing, at least this week, is maybe it is again that Brent spreads are really picking up on flat price this week. Another thing I was talking about with John this morning, okay, let's start from kind of first principles. What could be at play here? And one of them is related to something that we've talked about before, which is the easing resid or high resid crude situation in the West. Maybe the Gulf Coast slate is now getting a bit heavier, and they are basically pushing out more TI, for the same, let's say, level of stock draw that you might see in the US, if you can understand that. So maybe that's something there. I still think from a ARB perspective, TI looks extremely cheap. And, just looking at that, I would expect things to narrow.
Okay, fair enough. Be good to get your thoughts on kind of the freight element, kind of on DPP, Michael.
Yep, I can jump in for sure. So Neil, as you're talking about TI, I'm just looking again at how TD25 for Afras out of the US Gulf Coast are competing against the rest of the world. And they're massively undervalued right now on spot. So when I look at it, it looks like spot TD25 is over $6 a ton undervalued. So could cheap freight be helping WTI price so well into the rest of the world? I would think yes.
It definitely is. Yes, it definitely is. But the question is, how long can this last, I guess? So presumably TD25 will therefore rise, right?
It should. I will say that global DPP rates have generally been coming off. You and I spoke a little bit about the VLCC complex globally recently, and it is incredibly weak. And I was talking to James that a sobering stat for the V market is when Vs clean up and start carrying diesel. And that's exactly what we saw recently with a VLCC of diesel pointing towards the Med, deliver towards the end of August. And if you were to look at the TD3 curve right now, it's over 15 world scale points in contango through December. And one more sobering stat for the V market, back in early March, if you were to look at the trailing 90-day average of available Vs in the AG 2 weeks ahead, it was 22. And if you look today, it's double that. It's over double that at 45. So the number of Vs just sitting around has doubled in only just a few months. So it feels like freight has been doing a lot of work lower over the past 3 to 6 months to help price crude into different regions.
Okay. That should, Neil, you picked up a little bit earlier on the US Gulf Coast slate getting heavier. Keen to get your thoughts on margins, actually, because are we still kind of at a, solid position? I see margins are actually weakening, actually. So what do we think? New signal or just noise going into the turnaround season? Because slight concern with the amount of Vs that are sitting around. We haven't got kind of enough time for that to clear well into September, October, right?
Yeah, just the reason I mention this is just occasionally it's nice just to think about top-down first principles, because I guess I put out a piece yesterday, the day before, saying at 60 cents backward, I'm kind of neutral Brent spreads, and then it's gone against me again today. Not quite sure why, but it's just one day. But I'm just trying to think about what's the direction here. And I think I said already, I've been a bit early discussing some of the, let's say, directional things that are happening. And it definitely seems like margins are weaker than they were. They're coming down from a high level. Simple margins don't look too great in the East. We've got more OSP hikes likely to be on the way, so the term crude won't look so good either. And, generally speaking altogether, you've got a kind of weakening margin picture. You've got turnarounds ahead of us. You've got more OPEC crude coming into the mix. And for me, it makes sense that, directionally speaking, spreads should maybe have a weakening period, given all these kind of signals put together. And another thing on margins is that, relating to the resid story, if you look at one of our charts just now, which is, let's say, as a sort of reflective of the wider story, Johan Sverdrup margins against Forties margins in Europe, that has widened out a lot. They were looking a month or two ago pretty narrow, that spread, but now it's much, much wider, largely because Sverdrup FOBs have also come off. And, it just means probably you get a bit more light crude ejected out of the slate, and that probably adds to your pressure on things like the Brent benchmark. So I think altogether, there's lots of things coming together that should suggest, things like Brent spread should come off. It's just not going my way today, let's say. But that's okay.
Yeah, fair enough. We talked a bit this week about kind of a potential explanation on TI Brent if US Gulf Coast is likely to get a bit more resid than the previous months as well. Do you want to kind of chat about that a little bit?
Yeah, it's just similar to what I've been saying before, but it would make sense. And there's various headlines this week that also are, let's say, supportive of that. The one thing is the renewal of the Chevron license, right? That was a big chunk of very heavy stuff that was going to the Gulf Coast, and which was getting replaced with lighter crudes like Brazilian. And, so that's a welcome return for the Gulf Coast in terms of resid. So, yeah, it's just one of the things that we'll work on. I don't know if that necessarily is the explanation, but I think we should just hammer home the point. It looks like the resid tightness has peaked, probably globally, and that's got implications for crude. It's got implications for the light crude market and diesel, which we'll come on to in a minute, really.
Yeah, good segue into diesel, actually. Really quickly, we haven't got James this week, so quick fire round in terms of what's changed on the distillate side.
Okay, really quick fire. We'll get James on next week. I think that's the last one before James leaves us for a month, right? He's off in August.
Yeah.
Correct. So we need to get James back. Okay, so very quick fire. Feel free to add on to it, but obviously cracks are basically in free fall. Spreads are down a lot, but as a consequence of that, basically all major arbs into Europe are closed. And the message that we are thinking about this week is that that's kind of more of a fair value than we might have said last month. So if last month all arbs were quite closed, we probably would have said, okay, spreads need to rise to reopen this thing. But we think it's probably more justifiable this month, partly because we know, if you like, or we suspect, or the market tells us that there's going to be a lot more inflows into Europe this month than in prior months, partly as a result of all the open arbs last month. Very convoluted statement, but our listeners can play it back. In
0.5.
Exactly. The other thing that's, I do think, just from a kind of market psychology perspective, I think a lot of the panic is gone, and there's various things that add to that. We've already talked about Chinese exports. They've doubled from a low baseline, but it's definitely a new signal. You can see things like, if you look at the weekly data, the US yields are rising. They troughed out in sort of May, and they have risen very consistently since then. So that's another bearish signal. We've got things like the VLCC on the way to Europe. I think it's from Jubail, is that right? All those things help. And the one thing I would say just for next week is that at the moment, if you look at the East-West, Asia needs the barrels, also the FOB pricing. So Asia's absorbing these additional Chinese volumes for now. It doesn't look like tightness is completely left the Asian market yet. And the one conundrum that is also left for us to answer next week is just the strength of the HOGO. So if I pose this statement, the PAD 1 stocks are still low, but they're at a 15-week high, and we've still got very, very strong HOGO. That's something that we are looking, or we're going to wonder, when is this thing going to come off and help to sort of more sustainably open the Gulf Coast to Europe arm?
Okay. All right, we've covered a lot on this today. I'm going to do a quick round robin with all of you in terms of going into next week, which will be our 1 year anniversary of the pod, by the way. As I said, time flies when you're having fun. What are we looking at going into next week or the following weeks after, or one trade idea from each? Because I think there's quite a few scattered throughout today's podcast. So why don't we start with the top of the barrel? Jorge, do you want to start with Naphtha and we'll work our way down the crude tower?
Yeah, I think the main idea, but my comments would be a reversal trend on Norway Euro time spreads. They have been quite strong during the last 10 days or so. But I honestly, looking at the arbitrage and all the fundamentals that we have seen, I think this could be over and the peak could be behind us.
Okay, Phil?
Yeah, I think I'm going to focus on the east because the Atlantic Basin hasn't been very kind to me. I think there's a few signals there. Essentially, if we really can see Chinese exports slowing down a little bit, I think there's enough balancing there on the demand side that we could see a little bit of a rebound in Sing 92, and therefore also a kind of a bullish move on the east-west.
Fair enough. Imports into the crude tower. Crude, Neil?
I will go for EFS widens more, and I'll go for something related to flat price. I say that flat price hits 75 or something by the end of this 10-day period, unless there's a taco type scenario. But even into the run up to that, I guess flat price is going up. That's it.
Goodness. So you've gone with EFS and flat price. Those are kind of some ballsy
all
moves
the good
there.
ones.
I know. Yeah. Looking forward to next week's chat. And Michael, rounding out on kind of the freight side.
Thanks. Yeah. So on DPP, I think the TD3 curve price is lower to narrow down to spot. Whereas for TD25 and TD20 in the Atlantic, I think spot actually starts to price higher to revalue itself and close the spread to September. And then in the Atlantic for CPP, TC2 needs to come off quite hard to make that region more attractive on the product ARB side. And I think TC14 has some legs to continue to be sustained in price action.
Brilliant. Okay, cool. Well, that's it from us this week on the Sparta Market Outlook podcast. Thank you as always for tuning in. If flat price doesn't move on headlines next week, we'll eat our spreadsheets and I'll be having a firm chat with Neil. We'll be back next Wednesday with the fallout from the OPEC Plus meeting, plus more on China refining exports, I'm sure, and anything else that rattles the barrel in the next 7 days. And mark your calendars, as mentioned, next week is our 1 year anniversary special. So 1 full year of market chaos, crude jokes, and trying to make sense of it all. We'll be looking back at what's changed, what hasn't, and what we've learned along the way. So till then, stay sharp, stay curious. And as always, if you liked what you heard today, tell a colleague. If you didn't, give me a shout. Many thanks.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.